Welcome to Financially Fluent with Ray Godleski of Southeast Wealth Partners. Our goal is to equip you with the knowledge and tools necessary to navigate your financial journey with greater ease and efficiency.
Hey, good morning, Cindi. Thanks for joining me today on the next episode of Financially Fluent. How is your week going so far?
It is a great week. How about yours?
It is a good week. We are recording this on the last day of April. From a market perspective, we've seen a very bad start, and then things have kind of improved a lot the second half of the month. The weather this April has been fantastic.
Yes.
Not too hot, not too much rain, but a little bit of rain. And I hadn't seen pollen in like 2 weeks. How about you?
Yes, it's been picture perfect. So it's been good.
All right. Well, what are we doing today?
We are going to talk about Social Security benefits.
Awesome. I thought we might. We've had a couple of questions come in and answered those, some with clients, some with people that are kind of just in our network, if you will.
Mm-hmm.
And so it just been on my heart to okay, we got to talk about Social Security because it's a big deal.
Yes.
What are you hearing?
So, I've heard, you should do this or you should do that, but I think it's really more unique to a person's own situation, isn't it, Ray?
Oh, absolutely. It seems like, people, I run into people and they say they use the word always with Social Security, and almost with anything in financial planning, always is a word that probably shouldn't be used a whole lot. It's so specific to, someone's situation. So when someone says you should always do it on early, Social Security's not going to be around, I'm going to die at 70, someone's like, always wait till 70, you get the most you can. So hopefully today we'll be able to kind of get into some of those details.
Yes. And I know you always like a good trivia question. So I've got one for you, but I think we save that to the end and we kind of just jump right into Social Security right now.
Yeah, you're getting to know me quite well. I do like trivia, but let's get right into the heart of today's discussion, and we'll hold off that trivia towards the end. That would be fantastic.
Okay, let's do it.
All right. So I think one of the things, we talk about Social Security is, well, who's eligible for Social Security, right? And
yes,
how are you eligible and what are those benefits? So we'll put a link in the show notes today about it. But essentially, to be eligible off of your earnings record, someone needs 10 years of working where they're contributing to a Social Security. That's kind of how you become eligible off your own working record. Now, that's your own working record. You could also be eligible off of spousal benefits, survivor benefits, and even disability falls under the kind of that Social Security umbrella. Those are how someone gets eligible. Like I say, there's a little more details around it, but essentially, if you've worked a combined 10 years, you would be eligible off your own work.
Okay. How do they calculate your benefit?
Right. So the calculation, I will say, is a little bit complex. And so there's an acronym because, in our industry, we have nothing but acronyms. We have an alphabet soup of stuff. And the PIA, that's primary insurance amount, that is the calculation. And essentially, it's going to take your top 35 earning years. So when you look at your statement, which you would go to ssa.gov to download a statement, 35 years of earnings is going to be how they use that calculation.
Okay. And how would someone know what their PIA is?
So on there, that primary insurance amount, you take those 35 years. So it's important to understand is, let's say, in the 90s, someone made, $100,000 or something like that. And on their statement, it shows $99,000. That's because they may have been a cap of how much they could put into Social Security back then. But what's good is it's tied to inflation. So if you think about what $99,000 was back then, it's now worth more. So they do inflate how much you put in with inflation. And for folks that are high earners, they're getting taxed more on your Social Security at a higher income levels. So I think today's in 2025, I believe it's like $176,000. If you're making that much or more, all of it's kind of being taxed towards Social Security. So the other thing to remember with this is let's say a person didn't work for a decade, didn't work for 2 decades, right? And they pull up their statement and they're like,
Mhm.
wow, I got 9 years of history. I got no benefit off my own record. I just need to get another year in or another 4 quarters in
Mhm.
to get to that level. So you have your own PIA. Also, you could replace those. Let's say someone's been working for 25 years, right? Or even say 32 years. Let's say somebody's worked for 32 years. They got some zeros on there. Now they can keep working and replace those zeros with actual Social Security benefits, and you can increase your estimate that way. Now, the flip side would be, what if somebody, because when you look at your statement, it is a benefit statement. It's estimated, right? So if someone is, say, 58 and now they're not working, they're like, you know what, I'm done working. I'm not going to work any longer,
Mhm.
and they don't contribute to Social Security anymore. It's possible that their earnings could be reduced based upon their earnings record. You just have to look at it to see if that estimated benefit is going to be up or down by.
Okay. Um, you mentioned something about taxed. So is it true that your Social Security benefit is taxed even if you are fully retired?
Yes, yes. It wasn't always the case, but it's been that way for a long time now. And so that's one of those things that people aren't super happy about when they first learn this information. But essentially, 85% of your Social Security will will be counted towards your income, therefore taxed. Now, there's certain thresholds there where your Social Security isn't taxed. We're
Mhm.
only taxed at 50%, but a lot of people have enough earnings coming in where, if I want to put a nice spin on it, only 15% of your Social Security income would actually be tax free. Therefore, the other 85% of that income would be taxed. The thing, what we're not saying is it's not an 85% tax rate. No, it just means you're counting that income there. So whatever your effective, whatever your rate is. So if your top rate's at 22%, then that may be your actual tax rate on the Social Security income. I'll say one other thing too. If someone has turned their Social Security income on prior to being full retirement age, there's something called an earnings test. So it's really important to know what that level is. If you're out there making $35,000 and you've turned on your Social Security, you're going to get a reduced benefit based upon the earnings test, in addition to turning it on early. Just something for things people to watch out for.
Okay. Well, this might be a good time for a little Q&A part of the episode. What do you think?
Yeah, let's do it. Let's do it.
Okay. All right, here we go. A couple has a Social Security question, and for the privacy, we're going to just change their names, Daniel and Danielle, just to keep privacy. Here we go. So I, Daniel, reached full retirement age March of this year, 2025, and my wife is older than me, but she has not turned on her Social Security yet. She was born in June of 1956. When Danielle turned full retirement age, her benefit would only have been $900 a month based on her record, so we decided not to file yet. I am still working full time, making 6 figures per year, and I still have a mortgage. And we also help out our grandkids financially. I recently had a term life policy. The term life policy expired. So now I've applied for a guaranteed life insurance policy. So I am thinking of going ahead and filing for my Social Security benefit to help pay for this life insurance policy. Someone told me my wife should file right behind me because she would get about $1,900 per month, since mine should be about $3,800 per month. Is this true?
Right. So this is something I've heard about. And so in this scenario, what they were thinking was, let's let her benefit grow while
Mm.
he was still working. But come to find out, in this situation, he just turned full retirement age. And so he goes ahead and files for Social Security, getting that $3,800 a month.
Mm-hmm.
yeah, she would then need to file, and she's not going to get $900 a month. She's going to get $1,900 a month. So in this scenario, person was thinking, she's only going to get $900 a month, but in reality is she'll be able to get what's called a spousal benefit. So it's really important to understand how spousal benefits work. And so general prescription here, again, we're not giving advice for everyone on this, but in this scenario, it works out really nice that he would file at full retirement age. She's actually already well past full retirement age. So in a sense, you don't want to delay that at all, or you're just missing out on some money. So spousal benefits, you get about half of what your spouse will be collecting. Unless your own record is more, then you wouldn't, right? You're going to get at least half or more based upon, your own working record. So essentially what happens here is Daniel files, and that kind of unlocks the door for the spousal benefit. So I have seen this kind of situation where maybe Danielle, maybe she had been collecting $900 a month. Maybe, she's below the earnings test or not even working, right? So she could have been getting $900 a month all along. And then when he files, that unlocks the door for her to get the spousal benefit. I call it a bump up, and go from $900 a month to the $1,800 a month. Now, the other thing I'll say on this is he mentions about, life insurance.
Mm-hmm.
Yes, it sounds like he had a term insurance that expired. Getting a permanent life insurance policy, oftentimes that could be on a universal life or a whole life chassis, could be either one of those. And so in his situation, he's probably getting one of those where you apply, you know exactly how much you're putting in, you get a guaranteed death benefit on the other side, if you will. And then some of those policies let you have more than just a death benefit. You might be able to use it for chronic illness or long-term care, use that death benefit while you're alive. So let's say, for example, you had $500,000 death benefit, might be able to get out $10,000 a month towards long-term care or some kind of chronic illness. And that would reduce the death benefit, but you'd be able to use it while you're alive. So, that's not necessarily a bad strategy at all. And of course, those benefits are tax-free. And the other thing I'll say about that is, when someone passes away, eventually you're no longer in the married filing joint tax bracket. A lot of people in this industry would call that a widow's or widower's tax penalty. So anytime you're planning, or maybe a different scenario, maybe two people have similar Social Security benefits, and now that Social Security benefit has dropped off.
Mm-hmm.
You've basically lost half of your Social Security income.
Right.
And so having some type of other kind of benefit kick in, such as life insurance, could be a smart thing to do.
Okay, but going back to Daniel and Danielle, since she delayed and didn't collect right away, they have missed out on some Social Security benefits that they could have collected, right?
That's right.
But then it was bumped up because with the spousal filing.
Yeah, that's right. That's right. And so sometimes what may happen is, let's take this example, and let's say it's been 5 months past his full retirement age. So what he could do in that scenario, instead of missing out on 5 months of benefit, you can do a retroactive filing. Go ahead and file retroactively, go back to his full retirement age, and she would do the same thing, so they're not missing out on money. So you can go back 6 months when you file. As a matter of fact, this scenario, I know of another person that was 72 and never filed, just thinking that the benefit would keep growing.
Mm-hmm.
And it doesn't, right? It only grows to 70. So anything past 70 isn't helping you. But in that scenario, the person that's waiting to 72 to file is really just missed out. They can still file, go back 6 months, and get that much. So the furthest somebody would want to go is 70 and a half, file, go back 6 months to get the benefit. So yeah, good question about that.
Mm-hmm.
I do want to point out too, though, going back to the previous Daniel. What if he waited till 70?
Mm-hmm.
Okay.
I was going to ask you that.
So I beat you to it. So let's just say he waits till 70, to file. Why would he do that? Well, maybe he
Mm-hmm.
got declined for life insurance. Maybe he's not
Mm.
waited too long. He's had a health episode. Can't even get life insurance. So he might think about, if he waits till 70 to get it. And what that does is, yes, his benefit essentially is 8% more per year of waiting. So let's just say he was 67. So 24% more benefit at age 70. And then from a survivor standpoint, well, let's first go this way. Danielle's still only going to get half of what he would get at full retirement age, so age 67. That's her benefit, spousal benefit. But then should he predecease her, passes away, her benefit goes to what his benefit is at age 70.
Okay.
So that might be a reason to get it. And those are called delayed retirement credits if someone waits till age 70 to get it. And in that scenario, I'm not recommending that at all. I think we run through some numbers. We'll find out it's better in her situation
Mm-hmm.
to get it at 67, just so she can go ahead and start collect. Because she's not going to be able to collect that bigger benefit until he files. So in that scenario, waiting to 70 might not be best.
Okay. Well, you talked about that 8% more increase per year. So in that scenario, is that guaranteed?
Yes. I mean, according to Social Security, right? It is guaranteed. That's how it's been for a long time. But certainly, folks need to be aware, Social Security is in a situation where it may not be solvent forever. Hopefully
Mm-hmm.
it will be. But, somebody that's in their 30s might think differently about Social Security versus somebody that's already collecting. It seems
Right.
like there's a
Right.
political will, if you will, to keep things going for those already collecting.
Well, and it sounds like to find the right strategy, it's going to be very unique for each person in their situation. It's very unique to each person. It's not going to be the same all across the board.
Yeah, definitely. There's a lot of online calculators. They do these break evens. And I just, I don't see those as being the best answer necessarily.
Mm.
If you go to a Social Security office, they're not going to give you advice to your specific situation. They're going to try
I
to tell
think
you how the
very
rules work.
generic and generalized.
Yeah. They're just, they can't give you advice. They can try to tell you how the rules work. And it's possible they don't give you the right answer. I hate to say that, but depending on the office and the person, you may not get the right answer. Oftentimes, you may even be advisable to ask for a technical expert. Most time, my office will have that. So sometimes you got to go there. And then there are financial advisors that understand this well. There's some that maybe don't. So I do encourage people to get with an advisor that's got a lot of experience on this topic.
As you do.
Thank you.
So, what if someone has already filed a claim for benefits and they had a meeting with you and had a conversation and we need to change some things? They changed their mind. Can anything be done?
Yes. So if someone files and then, who knows, maybe they filed at 62 and then they got more information. They're like, oh, that is a huge reduction in my benefit. As long as it hasn't been 12 months, they can do a kind of you get one time to do this in your lifetime. You can contact Social Security and say, my bad, didn't mean to do it, right? And so but you got to put all the money back. And then once you do that, then you can wait. And then you can decide later, hey, I want to wait till I'm 65, or I want to wait till I'm, 67, full retirement age, or I want to wait till I'm 70 even. You can do it one time.
Okay, so you're claiming for 10 months of Social Security benefits and you need to change your mind. You need to pay back that 10 months, something to keep in mind. But at least you have an option.
Right. That's right. Yep. It's not too late if it hasn't been 12 months.
I think we should answer the other question that came up earlier this year about the person asking about the benefit of her ex-husband's record.
Right. Yeah. So in that scenario, we met someone that she was divorced. She was older than her ex, and she filed early based upon what she heard at a seminar. Now, I don't know I don't know if there's just misunderstanding or what happened, but she heard it from a seminar, and in her mind, she was going to file at 62 and then later on file on her ex-husband's record to get a bigger benefit. Unfortunately, it had already been more than 12 months because she actually had quite a bit of money in IRAs. She had quite a bit of money in what we call non-qualified asset or taxable accounts. So she actually had the resources to do the whoops, let me fix that. But it had been past the 12 months. It had been about 15 months. Weren't able to help her in that scenario. And so what we're trying to say there is she can still get a little bit of a bump based on her ex-husband's record, but she's going to get it reduced because she filed early. So we really want to be careful in those situations. Now, one thing she can do, and I don't know, if this is going to be right for her or not, but what she could do is when she reaches full retirement age, she could then at that point, well, first of all, at full retirement age, you can be working, make as much money as you want. You get no reduction, in benefit because you're working. There's no more earnings test. So that's one thing. But she could, at that point, at full retirement age, say 67, she could stop her benefit right then if she wanted to, use other assets or income, and wait till 70 or 68, 69 to get a bigger paycheck. Maybe she feels better about her health. She's got longevity in her mindset. And so in that scenario, it won't be a full replenishment, but at least you'll get the delayed retirement credits in that situation, waiting from 67 to 70. So she could do that.
Okay. Just a little follow-up with the ex-husband and wife. If they're not married anymore, how do they claim like the Daniel and Daniel situation where they were a married couple and she was going to her benefit was going to bump up because of his? But if the exes are not married anymore, do they still get that same benefit?
Right. So it's based upon your age. You wouldn't want to, if you're going to claim on your ex-spouse, you want to do it based upon your age in that situation versus what your ex-spouse's age is. So yeah, let me say just a few more things about ex-spouses and Social Security, because some people are concerned, like, wait a minute, I've remarried, and is my ex-spouse going to hurt my benefit or hurt my husband or wife's benefit? And it won't. So don't worry about ex-spouse, kind of rocking the apple cart of an existing new marriage, if you will. But let's go over how this benefit works for ex-spouses. There's certain rules. First of all, the marriage would have needed to last 10 years at least. They would need to be divorced for at least 2 years. And so let's see what else. Divorced spouse, right? So they got to be at least 62 years old, right? So the divorced spouse has to be at least 62 before you're really eligible to claim that benefit. You can't be remarried either, right? So if somebody remarries and is married, let's say they remarried and then they're 60, then you're not going to be able to claim that benefit off your ex. But if you wait till after 60, then you could claim off of your ex. Or if somebody was to get married and divorced before the age of 60, that'd still be something they could be eligible for. And the maximum benefit someone could get in that scenario is 50% spousal benefit off the ex-spouse's PIA. And that's only if the person claiming that wants to claim the benefit, that person needs to be full retirement age. So it doesn't really matter so much what your ex-spouse's is, as long as they're 62 or older, but you need to be full retirement age if you want to get all 50% of what that ex-spouse's PIA is. And from a survivorship standpoint, that's important to understand also. If the ex-spouse dies, and again, you had all the other requirements, you could get bumped up to a full 100% benefit. So the other thing I'll say on this is, what you're thinking, well, what if I just wait till I'm 70? Can I get a bigger benefit off my ex-spouse's record if I wait till 70? No. So once you're full retirement age, if that's your scenario, go ahead and claim the ex-spousal benefit. You're not going to get any delayed credits for waiting any longer past that. Important to know. And again, if you're remarried or something like that, don't worry about the ex-spouse messing up your Social Security. That's not going to happen.
And now, a quick message from today's sponsor. If you're looking for advice specific to your situation, then take a look at this episode's sponsor, Southeast Wealth Partners. To learn more about their team and approach, go to southeastwealthpartners.com. Southeast Wealth Partners is a great next step to be financially fluent.
Okay. Well, do you want to jump into some trivia?
Yeah, let's do it.
All right. I've got just one for you today, and I really think I'm going to get you on this one. At least I'm hoping. Yeah. Okay. In 1992, the U.S. men's Olympic basketball team, nicknamed the Dream Team, dominated the Barcelona Olympics. In 3 players from that legendary roster who are not Michael Jordan.
Oh my goodness. Okay.
I know you have a love for basketball, so I thought this one would be appropriate for you.
Okay. Tell me when I'm right. Okay. David Robinson?
Yes.
Okay. Larry Bird?
Yes.
Magic Johnson?
Yes.
Yeah. Continue.
Charles Barkley, Karl Malone, Patrick Ewing, Scottie Pippen.
Scottie Pippen. Oh my goodness,
Yeah.
really? And that was in Spain, if I recall. Barcelona. Awesome.
All right. Well, I'm gonna have to try harder for next time.
I like being right sometimes. So that's a good question. I appreciate that. Yeah,
You're
that's
welcome.
fantastic. Yeah, we'll do the 96 team next when they were in Atlanta.
Yes.
Hey, great episode today. Glad we got to answer some Social Security questions.
Mhm.
We will not limit Social Security to one episode. There'll be more on that, I'm sure.
I'm sure. Yes. Well, as we always ask everyone listening to please like, share, subscribe, and talk about this great podcast that you're doing to get it out there to inform everyone, because a lot of good information.
And if you have questions, send it to Ray at sewealthpartners.com. Thanks for listening.
See ya.
Thank you for listening to the Financially Fluent podcast. Click the subscribe button below to be notified when new episodes become available.
This communication is for informational purposes only and should not be considered tax, legal, or accounting advice. You should consult with a qualified tax professional, accountant, or legal advisor regarding your specific situation before making any financial decisions. Investment advisory services are provided only in compliance with applicable laws and regulations. Ray's opinions are not based on the specific financial situation of any investor, so they may be unsuitable for some investors. The information on Financially Fluent does not constitute a solicitation of the sale or purchase of securities. You should consult a professional advisor before executing a security trade or taking any other action based on information contained in this program. Securities and investment advisory services offered through Osaic Wealth, Inc., member, FINRA SIPC. Osaic Wealth is separately owned and/or other entities and/or marketing names, products, or services referenced here are independent of Osaic Wealth.